This podcast is brought to you by PwC.
Hi, and welcome everyone to our latest edition of Family Office Insights, our podcast for family offices. Today, I'm delighted to be joined by Nick Bedford. Hi, Nick.
Hi.
Nick is an investment advisor for NFG Partners. NFG Partners is a FINMA-licensed independent wealth manager serving high net worth individuals and families globally from their base in Switzerland. Welcome. So, we were discussing recently trends in the family office industry, weren't we, Nick? And you mentioned that more and more families that you're talking to are looking at their support models and how family offices get all of the expertise that they need. And the topic of outsourced chief investment officers, or OCIO, as we're going to say throughout this, are becoming more and more of interest. So can we start? Can you explain for people who maybe don't know, what is an OCIO?
Sure. Well, I think if you think of those sort of big institutional investors, pension funds, endowments, family offices, who we specifically work with, then sort of responsibility for the investment strategy would typically be managed by an in-house team who would have full day-to-day responsibility for that in all aspects.
Yeah.
Yale, I guess, would be the example that lots of people might think of. But there's a lot of organizations that simply don't have the same size or scale as Yale, but still need access to those institutional class capabilities and resources. So what we've seen is a growing trend, particularly amongst more modestly sized family offices, sort of managing up to about 2 billion or so, of actually outsourcing responsibility for the investment strategy, development, implementation, oversight, etc., to companies like us, which sit in NFG Partners, but essentially work for that family office and enabling them to rent rather than buy that expertise in.
Okay. And so you touched on it a little bit specifically then. Why do you think OCIOs have risen in popularity with some family offices?
Yeah, and I think, you're right. I alluded to it maybe one of the key reasons a moment ago, but cost is definitely one of them. So if you have an in-house team, then typically you would be looking at a chief investment officer, maybe a couple of PMs, some support and admin staff as well, salaries, pensions, benefits for those employees. Then you've got technology costs, other infrastructure costs, office space, etc., and that can quickly amount to getting on for $4 or $5 million per annum. So you can really see the family would need a very big asset base to begin with to efficiently amortize those costs over the course of a year. With the outsource model, typically depending on client complexity, we would charge the client anywhere between 20 and 30 basis points per annum of the assets under management. So cost is a big driver. And then the other big one I would point to is just, markets have got so much more complex in recent years. Arguably 20 or 30 years ago, there was less necessity for this kind of service. Back then, though, I guess it was more just a sort of stocks, bonds, and cash business. Even international equity might have been considered quite exotic. But now we have so many different asset classes, sub-asset classes to invest in, huge rise in the popularity of things like alternatives and private markets, and just not that many organizations are equipped with the expertise to make investment decisions on all these different asset classes and find the right funds and managers to fit into their portfolio. So having someone to handhold them and navigate through that is quite helpful. Increasing market complexity and costs would be the main two drivers I think we've seen.
Yeah, okay. And so in terms of the benefits of the OCIO, it's hard to say, isn't it? The OCIO model. What other benefits are there? Yeah,
well, so obviously we've just mentioned the economics, market complexity. I think there's a few other key things that we do that our clients really appreciate. One is enhanced manager due diligence and access, both in public and private markets. Public markets, things like making sure that if we're going to spend active fees, then we're making sure that they're choosing managers and identifying managers that actually add value rather than sort of closet indexes, for example. And then in private markets, that becomes even more important because if you just take private equity, for example, manager selection is what drives performance.
Yeah.
The difference between top quartile and bottom quartile managers can be absolutely enormous, way bigger than in public markets. So identifying the right managers and then using our network to make sure that we can actually access those managers, and then our purchasing power as a group to sort of make sure that we're executing at sort of institutional rates, as it were. So that's one thing. And then I think another big thing is making sure they're staying on track and not straying off course with regards to their long-term objectives and long-term goals.
I think that's so important in the family office space.
Absolutely. And the way we really want to do that is by being really disciplined and consistent with the implementation and the investment process, and making sure we're employing best practices there, not being tempted to overly adjust positions in the portfolio in response to things like short-term noise or bouts of market turbulence, and really just hand-holding our clients and helping them think through the market environments that we're in is a really big part of what we do, and not losing sight of those overall sort of return objectives. And then I think finally, really, it's just accountability.
Yeah.
We often meet families who might be quite thinly staffed, and the investment decisions will be driven by committees, but often members of the committee will have at least one or two other hats that they wear in the organization. There might be some volunteers on the committee as well, and that can sort of change and evolve over time. And so ultimately it can become a little bit fuzzy as to who is actually responsible for the performance. And we think that every family needs a CIO, whether that's in-house or outsourced, that has that sort of clear, constant fiduciary responsibility for performance, oversight, risk management. And it's really our view that portfolios perform best when you have that single point of accountability driving outcomes.
Yeah, totally agree. So what makes a good OCIO?
Yeah, well, I think it's a great question. And obviously, I think there's three pillars that we try to stand on that I think every good OCIO should incorporate: independence, performance, and partnership. Independence is really, really key. There's lots of bulge bracket institutions and large-scale money managers now that offer that outsourced CIO service. They're all very good shops, but they will have often proprietary strategies and managers, and they'll always have additional sources of commercial revenue. And we think that has the potential to create a conflict. And we really feel that this is a business that works best when all interests are aligned and you've got someone there cherry picking best in class solutions and then folding those into a customized plan for each family or family member.
Yeah.
Performance is obviously at the heart of everything we do, and it's not just good performance on an absolute or relative basis, but a performance track record that spreads across different market cycles, and performance that's really driven by processes that are robust, systematic, repeatable, and that's really our sort of core conviction is that sort of repeatability is the only way that you can really drive consistent long-term outperformance.
Yeah.
And then partnership. And I think, we spend a lot of time with our families that we work with in discovery, in the planning stage, really getting to know them, but not just the investment preferences. What are their cultures? What are their values with regards to, slightly more nuanced things like wealth, consumption, gifting, these kind of things, and really trying to form those close and enduring ties with them. And I think, what you can say for certain is over any long-term relationship, there will be periods where performance isn't perhaps quite as good as we want it to be. But by having that sort of close sort of cultural tie, making sure you're a good cultural fit for the family, that allows for trust to be maintained over any short-term blips.
Yeah.
So independence, performance, and partnership are really the three key things that a good OCIO should have.
And so when family offices come to you about this, what kind of problems typically are they trying to solve?
Yeah, so I think, look, every family will have their unique set of issues, but there are some common ones that we see come up. I think poor or inconsistent performance with regards to the long-term or long-run return objectives and benchmarks is one we see. Often that comes back to something we mentioned briefly earlier, and that's sort of tilting portfolios or adjusting portfolios based on short-term factors. Most family offices, most family offices that we work with are long-term investors and predominantly run evergreen strategies. So making portfolio adjustments in response to things like trailing 3-month performance is never a particularly good idea, we don't think. Another common one is insufficient expertise or resources in-house, particularly for those family offices that run quite complex multi-asset class portfolios that often have direct investments in things like VC, real estate, hedge funds, and that can lead to what we might call a competency mismatch, where there's effectively a misalignment between strengths and weaknesses of the staff and the investment demands that are placed on them by the principal and the complexity of the portfolio. Excuse me. And then I'd just say, one we hear a lot is infrequent or episodic meetings. So quite often when we first start working with a family, the committee will be meeting, let's say, quarterly. That only really gives you 4 times a year to actually make decisions. So one of the ways we want to add value and alpha for our clients is by taking advantage of dislocations in markets that may only really exist in the short term. And if you're only meeting quarterly, that doesn't really give you the opportunity to be quick or nimble in that decision-making process and act on those in a timely manner. So I think those are probably the 3 things.
There was a great opportunity 3 weeks ago.
Exactly.
So you said it yourself, and we say it all the time, no 2 families are the same, they're all unique. So when you're talking to them about taking on an outsourced CIO role, how much time do you spend tailoring strategies for one of your clients? Is it done and dusted in a day, a week, a month?
No, well, it's certainly not a set it and forget it, sadly. Our lives would be a lot easier if it was. But no, so you're right. No 2 families are the same, and often no 2 family members are the same. So customization is key. No 2 portfolios look alike. We work with family offices right across the spectrum, from early stage family offices that need help with everything from investment process through to governance, and maybe later stage family offices that have multiple investments globally and just need help realigning and optimizing that strategy. So as I said, we spend a lot of time in the discovery process with them, the planning, getting to know the investment preferences, tolerance for risks, liquidity, these kind of things. What are maybe some of the behavioral biases? How would they feel if they had bouts of volatility, drawdowns in the portfolio? And all those inputs really go into helping us define what success looks like for that particular family. And then our job really is to effectively provide success with a high degree of certainty. And you can't really do that unless you know what success looks like. So we spend a lot of time in the planning, in the discovery, and making sure each strategy is appropriately tailored for the objectives of that family.
So last question. Let's imagine for a second I'm a family or a family office. When's the right time to look around for an OCIO? Yeah,
I think, look, the outsourced solution is not a panacea, and it may be right for some families and not for others. But I think, there's a couple of key questions that you can ask yourself as a family to assess its sort of suitability for you or otherwise, many of which we've already touched upon. So is performance in line with benchmarks and long-term objectives? How frequently are we meeting, and how consistent is the investment process? Do we have sufficient in-house expertise to manage things like real estate, private markets, etc.? But ultimately, I think the decision to outsource really comes down to performance and also time. Is the time that you spend on investment management detracting from other really sort of key strategic day-to-day responsibilities like governance, legal framework, succession planning, etc.? And if the answer to that is yes, then outsourcing the investment management and alleviating yourself some of that burden so you can redirect and refocus resources on other sort of mission critical tasks within the family office can become quite a compelling proposition, I think.
Yeah. It's a really interesting topic. And Nick, I'd like to say thank you very much for joining us today.
Oh, you're welcome. Thank you very much for having me on.
It's our pleasure. Thanks. Bye.
Cheers.